Okay, good morning everyone. This is going to be the brief for the 6th of, what are we in now, October 2017. And it's been a phenomenal week in terms of FX, and there's been quite a lot of movement in the market, and particularly yesterday, looking at, I'm sure everyone was involved, the sterling currency, which was your main mover for the day, and this was on the back of Theresa May sort of cementing her own demise. She had her Tory party conference speech on Wednesday, in which it was a disaster. I think it's a bit unfair that people are trying to say that this was due to her persistent cough. I think with the British people, with the British public as a whole, that would, for anything, would give her more sympathy and work beneficial for her. But she was sort of mocked with a comedian on a YouTube comedian handing her a P45, which is the document you get when you leave a job. Just humiliating for her. And I think one of the main aspects to take away from this is that she didn't talk about Brexit. She is the leader of our country, and we are going into one of the most difficult and uncertain times we've seen in recent history, and yet our own leader, when she comes to speak and she knows the world is watching and she knows the world is expecting her to comment on Brexit, and then she leaves it absolutely and utterly blank and doesn't give us any indication as to what's going on. And then I think it's fair to then assume that this is because there has been no progress. So it's just been a disaster. And following this, training room, a bit like Corbyn then. Okay, well I'm gonna come on Corbyn in just a moment actually. I'll show you, I'll let you know what my views on him are. But ultimately, her not coming around and mentioning anything to do with Brexit, I think the market didn't take this very well. And what we were seeing overnight and sort of yesterday was we're seeing a push to remove her as the Tory leader. So UK May is facing a list of Tories calling on her to resign. Now this is just formulating. So Grant Sharp, who serves as the Conservative Party chairman, this is with David Cameron, is sort of mounting this offensive. But at the moment, I'm sure this has been bubbling behind the scenes, but it's only coming out into the open now. The numbers are still not what they need to be. The process for her to be ousted, or at least start that process, would be 48 lawmakers writing a formal letter to trigger a vote of no confidence against Theresa May. Now my views on this matter here is that I don't think now is the time, and I think this is shared by the market as a whole, looking at some of the headlines and some of the reports today. Because if she goes, well, who's left? Is it Bojo? The Remainer turned Brexiteer, turned hard Brexiteer, then the same individual who then made a disappearing act only to come back as our foreign minister, and again has been completely void of public eye, only to then hear comments that he will mount an offensive against Theresa May unless he gets his demands met. So in terms of who's on the line next as the leader for the Tory party is quite uncertain, and I think for this reason we're not going to see the strong push against her, because there's no one really there to replace her. And even if there were people there to replace her, I don't think anybody is willing to take her place, because as much as I like to criticize her, she's in a very, very difficult situation. Article 50 was triggered in March, and now we're coming up to the end of 2017, and I think it is absolutely fair to say zero progress has been made. There may be some morsels of progress, but as far as I'm concerned, no progress has been made, and I think this is now what the market is starting to price in. And this sort of uncertainty, especially if Theresa May does get ousted. Now, I say it's unlikely, but more unlikely things have happened. Donald Trump, Brexit, so on and so forth. So I think the market, especially in the FX markets, are being a little bit more cautious here. So what we saw, this was also aided by a bit of dollar strength. It's coming in the morning, and then just huge selling pressure. It's not so much the fact that we moved a huge percentage, I think from the top to the bottom is about 1.5%, so 1.43%. It was the fact that there was a distinct lack of buying appetite at any point in this sell-off, and I think anybody who was getting involved in this market could definitely feel that. We had this very important support level, which we saw on the third double bottom, which also coincided with some tops back here, which was providing support. And then finally, once that gave way, we saw a very sharp decline downwards. Let me transition across. Very sharp decline down and huge selling pressure. These are 1 minute candles. No real bounce, maybe a small profit taking, but look how aggressively the sellers came back in once again to drive the price all the way down to S1. Driving it down to S1, we see it'll pop through there as well. We come in for some retests, but nobody was really here saying, well, like this was a technical breakout and we need to reverse it. This just sort of initiated further selling into the market. And then we sold quite aggressively. A good classic opportunity actually coming here at S2, target 1 being the previous low, the next target being the 1.32 handle. And then we sort of sat here. We sat down below S2 for quite an extended period of time and then just grind lower throughout the day. It was this distinct lack of buying appetite which I think was the most interesting part of this move yesterday, more so than actually the fact that it moved 1.5%. In terms of key levels which we were taking out, let me just get the charts up so we can look at it on a daily continuation. Well back in our post-Brexit range now, taking out some really important key levels now. There was one opportunity where I was pretty sure we were going to see buyers come back in, and that was around the 13150 level. But you can see there was no real reaction. Provided some near-term support, only then to cut through once again. Now we're trading at the 131. So quite a phenomenal move there. Sterling weakness and dollar strength sort of working in the same direction. Now what does this mean for the future outlook for the United Kingdom? Well, let me just quickly pull up the FTSE 100. Sam North, I'm not going to read your comment at the moment because it's going to throw me off on a tangent. But I do know Sam took on a long here on sterling nice and early in the morning. But this inverse correlation between sterling and then the FTSE 100 it's remarkable recently. Are you still in? Well, there you go. Sam North showing us how it's done. This long FTSE 100 working very nicely as an inverse correlation with sterling. Sort of for the outlook with sterling, once again, making quite a rapid decline down back into post-Brexit lows. Of course, this then raises inflation fears. I think the Bank of England was getting pretty comfortable with the fact that sterling was on the rise, and this was a lot due to sort of communication. Them talking about inflation creeping higher, therefore they're going to act. So we still do have a rate hike priced in, I think about 79% for December for the Bank of England. But the reason the market doesn't seem to care is that this is as a response or as a reaction to inflation, which was due to political and economic uncertainty. So I think if we continue to see political and economic uncertainty, we're going to continue to see sterling sell off, and we'll need far more than one rate hike to counteract this decline in the FX pair. And this again puts us into quite dangerous territory in terms of the outlook for the United Kingdom, because without doubt we're going to see inflation start to creep up once again. And then we were seeing hawkish commentary coming out of the Bank of England when we were trading above the post-Brexit highs. So it's going to be interesting to see how the commentary sort of changes right now as inflation now continues to trickle higher on the back of sterling. Just a final note on this, I think the current FX trades have been pretty remarkable now for about 6 months. Euro USD going higher, sterling selling off, and then rallying pretty heavily on the back of hawkish Bank of England. But now we're seeing these contrarian views where euro strength on the back of a hawkish ECB and dollar strength coupled sort of coming from hawkish commentary coming out of all Fed members, as well as good economic growth, solid inflation numbers. So these work against each other, so that I think FX, which was our saving grace for the whole of 2017, given the fact that equity markets have been absolutely null and void. Even the currency space is becoming a little bit more tricky. Sterling at the moment, we're seeing some sterling weakness in the near term, but then we're going to start seeing more hawkish rhetoric come out of the Bank of England. This hawkish rhetoric is going to be positive for sterling, plus we're going to see, well, the Fed is still on a hiking cycle, so it's going to start to counteract each other. So unless equity markets pick up soon, getting a little bit nervous, because FX has been the best of the asset classes to be trading in 2017. So let's hope we can get a sort of binary move in one of our currency pairs in the near term. So that's sterling. Sam North, almost sounds like I'm sticking up for Theresa May. You know what? at the end of the day, I am British. I'll stick up for the underdog, and I feel utterly sorry for her. She's in a very tricky situation. But look, she needs to go, and I think what the market is saying is right. She may survive this one, but there are going to be future blunders, and she doesn't have the support of her party. She doesn't have the support of the public. And what's terrifying for me is then who replaces her. As I was speaking to Anthony earlier, I think there's a good chance Jeremy Corbyn will come and play. Now, he's of the stance that there'll be absolutely no Brexit if Jeremy Corbyn sort of takes over. I think he will go ahead with a Brexit, but with a far more unifying approach and initial sterling weakness, and then sterling strength to as the sort of Brexit negotiations continue. So I think, again, the better option of Theresa May, Bojo, is Corbyn, and I'm saying this on a recorded video which is going to go onto YouTube. So next, what other interesting moves were there yesterday? Well, we saw some ECB source comments come out, and they were talking about the trade-off with duration and quantity of quantitative easing. And there was also some mention of the FX risk as the euro is trading still relatively high with the dollar. Still right up here at the top of our range. Consolidation reversal has taken place, but still right up here at the top of our range. The market was pretty comfortable with this idea. What we were seeing here is at that time, me and a lot of the stage 2 guys were in a short here at S1. Target was here, didn't get filled for 2 ticks, only to see it then rally all the way back. But this little move up here was, well, move down on the FX risk, and then we saw a slight move higher on the Catalan situation, where Catalan leaders are a little bit uncertain as when to, well, there is a divide in the leadership as to when to trigger the independence, and I think this is understandable, which means they're going to delay the process. Delaying the process gives more time for negotiation. We saw a small uptick in the euro. We didn't really see that filter through so much into the DAX, maybe a little bit into the euro stocks, but mainly the IBEX being up over 2%, which was obviously the underperformer given the Catalan situation. So that was on the euro front. Was just mentioning the ECB. So they said there was going to be a trade-off between duration and quantity. So the sort of two, the market's looking at sort of two scenarios here. The taper is taking place. I think the market is fully comfortable with that and priced in. Now it's a matter of how much and for how long. And on that basis, I think initially coming into maybe mid-2017, the feeling was very much that we're going to reduce QE, asset purchase program, particularly from 60 billion to 40 billion a month, and that would be over a duration of 6 months. The market seems now to be more focusing on a reduction to 30 billion, which as a headline would seem a lot more hawkish. From cutting from 60 to 30 is obviously a greater reduction. A greater reduction means that we'll see an appreciation in the value. But then the second part of the equation is the duration. So if we look at the option we were discussing earlier on in the year, which is 40 billion for 6 months, that equates to another 240 billion euros worth of stimulus. The sort of approach that the market is now looking at, which is the 30 billion, so a greater reduction. However, this extending over 9 months results in an injection of 270 billion into the market, and that that in itself would be greater easing. So let's see how things develop, and of course this is going to be discussed far more in the current October meeting, and we'll get some more clarity here. I don't think the Catalonia nor Spain will back off. Probably Monday Parliament meeting will go ahead. I think one will give way, because if we look at we had Article 50, and in Article 50 there was at least some sort of clarity as to how sort of separation between these two parties happens. But with Catalonia, what we're seeing is the fact that leading financial institutions as well as leading other large firms are going to be moving out of the region. This is also being helped by the Spanish government, because they're going to make it easier to keep that social and economic pressure on Catalonia. And this sort of economic outflow is something that, first of all, it will cause uncertainty in the Spanish economy as a whole, which won't be good for Spain, and second of all, it will be devastating for the Catalonians' regional economy. And for those two reasons, I think no matter how much sort of issues they may have with each other. It may not be the most beneficial move for either of them. So negotiations, I think, are on the table at the moment. In my personal opinion, they could go ahead and announce their independence over the weekend. Okay, so that's talking about your sort of FX moves. Finally, we're going to talk about equity, which gets spoken about, I think, less and less and less and less and less as every trading day goes on, and that's because we have, let me get the article up just here. So US stocks break 20-year record. And what's a 20-year record? Well, they've grinded higher again. US stocks hit their 6th consecutive closing highs on Thursday for the first time in more than 20 years, fueled by signs of economic strength, renewed optimism over tax cuts. I'm going to argue the tax cuts part, but let's talk first of all about the economic strength and renewed optimism. So equity markets grinding higher and higher and higher. Let's just put this on a daily continuation just to put it into perspective. This is a vertical increase in the equity market that we've seen. This has resulted in the VIX closing at trading at all-time low levels yesterday. I think the reading was of hitting the lowest closing level on record. So lowest closing record of 9.19, which was previously 9.31, and that was back in 1993. There is some talk about. Actually, this might be quite ironic. I was reading a headline where Donald Trump was saying this is the calm before the storm when meeting with his military advisors. I'm not going to be the person. Transition. That's the equity market I was talking about. Thank you, Max. A steep decline here. So Donald Trump was talking about the calm before the storm in terms of military reaction to North Korea. I think with this equity market, we are definitely in a calm. Now, whether I'm going to be the person who goes on and calls the storm, probably not. Still looking to buy the dip for sure. But equity markets continue to grind higher and higher and higher. And this is amazing because this is the perfect situation for the Fed. We've discussed earlier in previous briefings that the dollar index is trading still very low relative to where it was in 2016, given the fact that inflation was tracking about 2.9% then. So the dollar is weak, so we can go into a hiking cycle without affecting the currency pair too much, whilst equity markets continue to grind higher and higher and higher, even though the likelihood of a hike is increasing. So this is perfect for the equity space. In terms of sort of Fed commentary yesterday, we had Harker and Williams. Harker saying that we have now penciled in the third rate hike. Williams sounding very optimistic. So these are sort of your Fed members. However, we did have Lagarde speaking as well yesterday, who's the managing director of the IMF, just giving us some insight into what's going to happen in the world economic outlook. And even she was saying that she's noted that the cyclical pickup in investments and trade in advanced economies, particularly Europe, is creating better than expected growth elsewhere. US growth will be above trend this year and next. So even the head of your IMF is talking about the economic growth in the United States of America. So I think the hiking cycle is very much underway. And the Fed has sort of renewed optimism in the economy. Plus, they have gone ahead and they are looking to shrink the balance sheet, and they're going to get their third rate hike, which means that confidence in the communication from the Fed will be at all-time highs once this hike goes through. So they'll be able to communicate and manage expectations quite closely. Again, with Eurozone improving and the Fed improving, I think as we move away from these clear FX trades, we're going to come closer and closer to more volatility in your equity space, because the FX markets are going to become difficult because we're going to see tightening of policy, but that tightening of policy should result in a bit more volatility in your equity space. Just keep an eye out for that. In terms of your commodity market, well, oil was on a bit of a rampage yesterday, actually. Just tearing higher and higher and higher. This is to do with renewed belief that Saudi Arabia and Russia are going to be looking to deal with this supply glut. As we know with the equity space, as we know with commodity space, there's two products in particular which, when they have a direction, do not stand in front of them. That's your oil and DAX. This is as a result of the liquidity plus their nature. So if anybody who watches these markets knows that they like to pick a direction and stick with it, then you'll see more sort of trend continuation. But just get this on a slightly longer time frame, so we can discuss the technical trading of it. So sort of we were trending lower. Post DOE saw an increase in US output production, breaking through pivot, really bullish move to the upside, breaking through R1 50-50, sort of stalled around the $51 mark. Let me just have a look at a 1 minute chart to see how we responded to that level when we initially got up there. So I wouldn't say this grind above 51 was even technical. You can see there was a bit of consolidation before the move. As a whole, I'm still forever bearish oil markets at these prices until we sort of see more clarification with regards to the OPEC, non-OPEC agreement, but with Saudi Arabia and Russia in cahoots looking to reduce the supply glut. Sort of two big players in the market would justify why we saw quite an uptick in oil. Sub 50, I'd say by the end of next week, for sure. Okay, now on the data calendar front, we have non-farm payrolls today, which it's a shame because this was one of the biggest events. Everyone looks forward to it. It was so exciting. Everyone couldn't wait for non-farm payrolls to come because it would filter through into the equity market, the dollar, your bond market, your FX market. When there was that good correlation between oil and dollar, would see it affect bonds, equities, fixed income, and commodities. But it's becoming lesser and lesser important as we see that the employment industry in America is pretty strong. We discussed this on a number of occasions, but with unemployment tracking around 4.3 to 4.4%, actual job gains is becoming less important. So on the outright, non-farm payrolls is nowhere near as important as it once used to be. This coupled with the fact that we're still recovering from these Hurricane Irma, Hurricane Harvey, which is going to have an impact on your employment numbers, given the fact that it's more difficult for people to get to work. Your infrastructure is damaged, as well as there's flooding, so on and so forth. So given the fact that we've had these two hurricanes, there's definitely going to be an anomaly within these numbers. Following Katrina, I think the numbers were something around the lines of, it was tracking at 174,000 jobs created just before Hurricane Katrina, and then following Hurricane Katrina, we saw a number 54,000 jobs were lost. So we are going to see this impact. So the headline, as unimportant as it's becoming, increasingly this is going to be particularly unimportant following the hurricane. However, this doesn't mean today is going to be wasted and this report's going to be wasted. We still get average earnings in the United States. Now, we know that average hourly earnings is what's going to drive up your inflation as more people earn money and spend money, in line with sort of your Phillips curve argument. So average hourly earnings is once again going to be the main takeaway. I was sort of discussing this earlier. I don't really feel that average hourly earnings should be affected that much by the hurricanes. One could argue the fact that there was less jobs created, so there's less competitions may drive down average hourly earnings, but I think that's a bit of a reach. So in terms of your expectation, month on month expected at, let's just quickly have a look here. Yep, 0.3, which seems to be your standout expectation. Now, 0.3 has been sort of the top end of the range. I think anything above 0.3 is just another factor giving confidence to the Fed and market participants that a hike is definitely going to happen. I think if we start approaching 0%, at that point we may see some dollar weakness, but as much as I've said the average hourly earnings won't be affected by the hurricane, I think if we got a 0% reading, the market is going to shrug that off. Just saying that this could be, again, a filter through due to the hurricane. However, if we get a positive reading, that won't be shrugged off, in my opinion, due to the hurricane. So we definitely have more risk for dollar strengthening in this situation than dollar weakening. So really looking for a reading of 0.4 or above. As I said, if we get 0%, I'm pretty sure the market will just say, look, this whole jobs report is irrelevant and unimportant. That's going to be a main event for today. So ahead of this, still quiet ranging markets. Just be careful. We know that we can see some erratic price action coming into non-farm payrolls. And then looking at the rest of the calendar, we have Canadian employment change. This will be important to look out for if any of you are trading the CAD. Going into the late afternoon session, we have your Baker Hughes rig count, as we always do on your Fridays. I think we're seeing ExxonMobil's distilleries now back at full functioning levels. We got that headline only a couple of days ago. So what this means is that we're starting to see normalization in your oil and gas markets. So next week onwards, I think the DOE numbers are going to be back to normal, where the market will react as expected with regards to those. Baker Hughes rig count, an important one to look out for on Monday to give you a direction in the oil market. BOE Haldane speaking on the great trust shifts debate. No tech, no next. That's meant to be no text to be released. And then we have some Fed members. So we have Fed's Dudley speaking of monetary policy. So that could give you some interesting moves if any of the live guys have the time. I'd definitely be keeping an ear out for that. And then Fed's Kaplan, Soft Hawker speaks on workforce conference. So I think both of these are actually quite interesting. The workforce and this whole whether the Phillips curve still works or not would be quite interesting as an approach to see what Fed's Kaplan has to say about that. And Dudley speaking on monetary policy couldn't be more topic if it wanted to. So that's after your European close. So if you guys are sticking around, definitely keep an ear out for that. Otherwise, that's just about covering everything. Thank you very much, guys. Best luck trading today. Be careful in the morning ahead of non-farm payrolls. It can get choppy. Sorry, I just forgot to mention, so cable did come in for a bit of a classic at the 1310 level. It's just been hovering there. No real move higher. But look, best of luck. Feel free to reach me in the training room if you have any questions. Thank you very much.